Let's talk about that and more with your leadoff guest, Stephanie Guild, Chief Investment Officer of Robinhood. Probably one reason, by the way, Stephanie, that you and your team have seen inflows surge. Your stock, by the way, one of the hottest in all the land as well. What do you and your team see for 2026?
Yeah, we have definitely seen high participation, and you've seen net buying really, especially since the summer. That being said, net buying has trailed off a bit from our customer base from that sort of peak October 29th period, but it's still there. For next year, we are looking at still another strong year, as you just described, but we don't think it's going to be at the S&P level as strong as it's been. So we're not predicting double-digit returns for next year. Our base case is around a 7,500 on the S&P 500 this time next year. And that's, around 8.5, call it 8.7% to be specific. It depends on a lot of things that are going to happen, potentially happen in the economy. And we do have some risks out there. There is a potential government shutdown, especially on the way. And, what happens with rates and the labor market will also be important. So we do have some potential probability ranges around that. But our base case is solidly strong.
That's about, Stephanie, about historical returns. I mean, the S&P 500 tends to double about every 9 years. The median return's about 8%. But you're not calling for a downturn. You're still fairly optimistic. 8% is better than 0%.
Yeah, it's just not the double digits we've seen the last few years. But I think it's just because we expect this is starting to be a little bit what a lot of people think, but that broadening. When we came up with our base case, we looked at what earnings expectations growth is for each of the individual sectors. And we saw, the tech sector is expected to grow at 27%. Its average going back to 2011 is 12%. So we sort of started saying there's a lot already built into the tech sector expectations. And we think that there's probably more beats coming in other sectors. And that's why we think at the S&P level, we still see a good year, but it may be more supported by other sectors besides just tech this year.
Yeah, and I kind of read between the lines, maybe incorrectly, on what you said at the top of your answer, which is you sort of see what other people are talking about. I presume, and if I'm wrong, tell me, Stephanie, and I know you will, are you talking about the potential for some froth around the AI trade?
Yeah, I mean, obviously, we've started to see the froth come off already, since the beginning of November. But I think there's just going to be more scrutiny on it. There's a lot of talk about some of the new LLM models that are going to be coming out named after fruits and vegetables. But I really think that's going to start to be a commodity, and it will start to be where is the rubber meeting the road, and where is it actually improving efficiencies, cutting costs, and creating actual revenue.
You're talking about, what is it, Google's Nano Banana, I think am I right on that? That's their Gemini,
there's
engine.
Avocado, there's Mango. I think OpenAI, has Avocado, and then there's Mango, I think, for Meta.
Why did fruits get associated with large language models?
I have no idea. Maybe they're complicated and sweet. I don't know.
Complicated and sweet. You just described me, Stephanie. Let's talk about global demand. Let's get out of the United States, all right? Because we made a lot of money here, to your point. Mm-hmm. But if you bet on markets outside of America, you've probably made even more money this year. In fact, the MSCI All Country World Index, ex the United States, so stripping out America, has beaten us by the widest margin since 2009, financial crisis, obviously. Do you see Europe and Asia outperforming us again next year?
Yeah, I mean, I think it was an easy move higher for Europe, especially about half of the returns that you had from investing in Europe, for example, came from just the appreciation of the euro relative to the dollar since the start of the year. And I think a lot of that is done. So I actually, we're probably the most bullish, and we've been having a lot of debate about Japan, for example, because there are kind of two different things happening from a policy perspective there. But where we are still bullish, and it's been, the froth has come off a little bit recently, is just in the China tech play. We think there's still a lot of room to run there. Valuations are pretty inexpensive. They have a lot of those open source models that will probably start to be attractive for companies who not can't necessarily afford some of the other ones that are out there that aren't open source. So I think there's a lot of opportunity, I think, still to be had in Asia, particularly in the Chinese tech play.